Hi, Christian. Thanks for joining me.
Excited to be here, Susie.
Many of our clients have questions about bonds. One we hear often is, why hold bonds at all when stocks have historically had the potential for higher long-term returns?
Yeah, you're right, Susie. We often hear that clients are questioning the reason for holding bonds. But we believe that bonds are very important. Let's consider the roles that bonds play in a portfolio. One is a cushion. Stocks are historically a strong asset class for growth if you have a long enough time frame. That said, stocks don't go straight up. So while it can feel frustrating to miss out on gains when the market's rapidly growing, bonds may help when those inevitable bumps happen in the market. And although bonds also carry risk, I sometimes like to think of them as a seatbelt in a car. While you hope you don't need it, it still helps to have it on to help you if the unexpected does happen. This becomes even more critical as your time frame for needing those investments shortens, and you don't have the time to recover from that potential decrease to your savings. The other consideration is that many people assume bonds are only meant to stabilize the volatile nature of stocks. What they may not realize is how large and varied the bond market really is. Bonds can help address many objectives, such as income generation, inflation risk management, or tax considerations. So just like we stress the importance of stock diversification through company size or geographic region, it's also important to diversify your bond holdings. Bottom line, bonds can provide additional diversification in many ways to your portfolio, and depending on your objectives, should still be a critical part of your overall investment approach.
Love the cushion and seatbelt analogy. In addition, the diversification. Well, you mentioned some clients look to bonds to provide income. What are the options and also, importantly, the tax implications?
There are a lot of options for clients seeking to take income from bonds. One's a bond ladder, which is a portfolio of individual bonds with various maturities. Individual bonds have a set interest rate, which could help investors plan expected income, whereas the income from bond mutual funds may vary, since it often depends on the current rate environment. What becomes important to consider is both the risk and the taxation of the income. In terms of risk, you want to ensure you're purchasing a bond where you are confident the issuer will be able to meet its obligations. Sometimes people are attracted to higher yielding bond investments, but those bonds are paying higher yields because they have additional risk associated with them. This can include the potential to default, which means you may not receive any income. In a worst case scenario, you could even lose your principal. And if you're in a high tax bracket, taxation may become more of a consideration. For example, while the income from corporate bonds is taxed as ordinary income, the income from treasury bonds is taxed at the federal level but exempt from state and local taxes. Then there are also municipal bonds, where the income is exempt from federal tax and may also be exempt from state tax if the bond is in the investor's home state.
All right, so risk and taxation. Great. We know that part of bond investing is managing interest rate risk. What can help mitigate that risk?
Interest rate risk is certainly an item we hear a lot about, especially given how much press the Federal Reserve now gets in the news. So when interest rates rise, bond prices fall. This can catch investors off guard, like in 2022 when interest rates rose quickly and many people saw the value of their bond portfolios decrease rapidly, unfortunately in tandem with a falling stock market. Alternatively, while rates are higher now, many clients who value the liquidity with attractive rates in safe instruments like money market accounts could be surprised if rates decline. When that happens, money markets can suddenly pay a lot less. So one way to hedge against interest rate risk is a bond ladder, which I mentioned earlier. With a ladder, you're holding the bonds until they mature, and they are designed to pay your principal back at maturity. So if rates fall, you don't run the risk of selling the bonds at a lower price, and the longer bonds you're holding will allow a portion of the portfolio to maintain the higher rates originally purchased. On the other hand, if rates begin to rise, the bonds that are maturing can be reinvested to purchase new bonds at these higher yields.
Well, Christian, you mentioned different ways to buy bonds. What are the benefits and considerations for individual bonds, bond funds, or ETFs?
Yeah, you're right, Susie. There are definitely a lot of options. Earlier, I talked about how bonds can help play different roles depending on an individual's own objectives, whether that be appreciation, preservation, or maybe both. This distinction can be a good starting point to understand which approach, or even approaches, could make sense for you. As just mentioned, individual bonds may allow for some certainty and stability, since you know the interest rate and the expected principal. The downside of that is they don't provide as much flexibility as other options, since you may be impacted by interest rate risk if you sold them early. The other downside to individual bonds is they can require a strategic, sophisticated approach and may require a larger investment to become well diversified with multiple issuers. Alternatively, bond funds and ETFs provide you access to a basket of bonds, which can be a much more efficient approach to investing. It reduces the risk of holding only one issuer, while also allowing you liquidity and convenience to access whenever you need it. While both provide these attributes, ETFs provide the most liquidity because they trade throughout the day, and they tend to historically track an index, which allows them to be very cost effective. Meanwhile, many bond funds are actively managed and only trade daily. That said, the price of both bond funds and ETFs will fluctuate because they are exposed to interest rate risk and the credit risk of the bonds they invest in. A final option to consider is a fixed income separately managed account, or SMA. An SMA has some similarities to a mutual fund, except you own the securities directly. That can offer both the benefits of professional management and holding individual bonds. However, SMAs have a higher minimum investment than many actively managed funds.
Great considerations. Thank you. All right, last question. How can clients decide the right amount of bonds to hold?
The right mix of investments, or what we call asset allocation, depends largely on your personal situation, such as your goals, time frame, and comfort with risk. In general, those closer to their goals or needing the money might seek more stability, while those with a longer time frame might want less since they can ride out the swings of the stock market. For example, we worked with a lot of clients during the tech bubble who were about to retire and were overweighted in stocks because they viewed bonds as holding them back from the growth of the overall portfolio. Unfortunately, when the market corrected, many were down significantly more than they otherwise would have been if they had maintained a disciplined and diversified allocation to bonds. Some of those people even had to delay those retirement plans. On the other side, after the great financial crisis of 2008, many young investors were hesitant to be invested in stocks after such a challenging decade, and they maintained high levels of bonds or short-term holdings. Regrettably, they missed out on a lot of growth over the next 10 years, which may force them to save more now or have to work longer to make up for it. You may also have a distinct asset allocation for each of your goals, whether that be college, retirement, or legacy planning. And you should periodically revisit and update your asset allocation, especially if your financial situation or time horizon changes. The most important part is making sure you have a plan. Fidelity has many educational resources as well as financial professionals able to help you make an informed decision that applies to what your own personal situation may call for.
Christian, thank you so much for these insights.
Thanks for having me.
If you have questions about investing in bonds, reach out to your Fidelity representative. If you don't have a Fidelity representative, visit fidelity.com/findinadvisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.